All right, what's up, guys? We're going to talk about shorting Facebook into the freaking ground. Maybe. But guys, market is up big time here today. We're up 2%. Here's the interesting thing. Big money is going everywhere, right? They're going into energy. They're going into financials. They're going into industrials. They're going into transport stocks. Big money's going into everything in a big fashion today, guys, except these tech names. Right? These tech names that have led the QQQs back up towards all-time highs are actually seeing a little bit of selling pressure today as the market itself is breaking out. So we've had a kind of this instance, guys, where the QQQs have been incredibly strong on the backs of Amazon, Apple, Google, Facebook, where the S&P 500 has been a little bit lackluster. But now we do have the daily squeeze finally firing today for the S&P 500. And what we're seeing, guys, is money going into names that we haven't seen getting much love lately, and a little bit of money coming out of the names potentially in the names that have been getting love, right? So while the energies, the financials, ABC is all up here today, you got Netflix down about 1%, 3% rather. You've got Amazon coming down a little bit. You've got Google, right? Trying to fill that gap on the daily chart, having a tough time. So with Facebook here, guys, what I'm looking for, right, isn't so much potential rotation, right? Now, that would help the case here. If big money starts getting out of tech and, putting that capital elsewhere, that would help out the case here. But as Facebook sits on its own, guys, right, what we're going to talk about is a concept known as reversion to the mean. And the easy way to look at this is, a stock has to come home at some point, right? And home for a stock, guys, tends to be that mean, right? Which is that 21 period EMA on the daily chart. And as a good rule of thumb, when a stock is 2 to 3 ATRs away from that daily 21 EMA, the probability is rising that the stock is going to return to the mean. Now that can take place, guys, in the fashion of a nasty pullback. That can take place in the fashion of the stock chilling out, chopping around, and consolidating long enough for the moving average to come back up there and meet the price. Now, could Facebook keep running, right? Facebook could go to 260, 270, 280. Nothing is set in stone in the market. However, we do want to, trading's a business, guys. We want to trade our business. We want to build our business around the probabilities. You can make a living based upon the things that happen most times versus, an instance where a stock just kind of continues to defy everything and keeps running and keeps running and keeps running. So, on average, as a general rule of thumb, when a stock is 2 to 3 average true range moves away from the 21 EMA, there is an increasing probability that the stock is going to return to the mean. So in the case of Facebook here, guys, we are well above the 21 EMA, which we'll talk about in a second. The probability, in my opinion, is beginning to rise that Facebook is either going to A, begin a steady sell-off, eventually meeting back up with the moving average, somewhere right around here, or we're going to chop around, slow down, and consolidate long enough for the moving average to catch up. Could we continue to run forward? Of course, but I like working, guys, within the probabilities. So we're talking about ATR here, average true range, which we get over here on Thinkorswim. You guys can see the ATR column. For those of you unfamiliar, ATR, average true range, guys, it's just a reading of how much has this stock been moving up and down over the past 14 days. The current ATR for Facebook is about $7. That means that on average over the past 14 days, Facebook goes up or down about $7, give or take a few every single day. So what we're looking for, guys, is a stock that is 2 to 3 average true range moves away from its 21 EMA. Facebook's 21 EMA is over here at just about 212. 2 ATRs away from the 21 EMA would be 226. As you guys can see, Facebook is significantly well above the 2 ATR level at 226, and as a matter of fact, after hitting 240 this morning, this thing was about 4 average true range moves away from its 21 EMA. So in plain English, guys, could Facebook continue to run? Absolutely. What are the probabilities point more so towards? A slowdown, if not a fade, a reversion to the mean. So how did I go about trading this, right? We just covered the thought process. We're expecting Facebook to potentially slow down, lose some steam, right, and chop around for a bit, or hell, even better, begin an ugly little fade. Now, you could buy puts, right? And of course, if Facebook actually does sell off, you can make some money. If you buy puts, guys, and Facebook just kind of consolidates and chops around for a couple of days or a week, your puts are going to get torn to shreds. You guys, if you're familiar with me, y'all already know what I did. Call credit spread. Let's take a look at that. So as always, guys, max profit on this trade is a little bit over $1,000. And we went to the monthlies, June 19th expiration. So we're giving this trade just about a month here. In my call credit spread, I shorted the 247.5 contracts, and as protection bought the 250 contracts. So all I need, guys, at the end of the day to make my $1,000 and change is for Facebook to close anywhere under 247.5 come June 19th expiration. But the beauty here, guys, with these spreads is that with every hour that passes, if we are not quickly running towards 247.5, those puts are losing value, and that's value that goes into my pocket because I shorted those puts, right? I sold those puts. So, you can already see here, guys, just on the little bit of fade we've had here today. I opened this position a couple of hours ago, right? And we've gotten a little bit of a fade, nothing insane, right? Nothing really even to write home about, but premium decay is working in my favor, right? This thing's chopping around, fading a little bit. What's happening to those out the money calls? They're beginning to lose value. So at one point today, guys, I was already up about 15% of max profit on this thing. We're up closer to 8 to 10% of max profit right now. And you're not looking for max profit in one day. That's not the purpose of these trades, guys. What we're looking for is a bigger picture setup that is showing us that the probability is raising, that we are likely to kind of be coming towards the end of the road here. And I'm looking to collect the premium from these 247.5 calls as they're all jacked up right now, but are ultimately going to go to zero unless we can get through 247.5. Right, so why not buy puts? Because that's kind of the easiest way, and for most new options traders, that's initially how we attack the game. Don't get me wrong, guys, there's a time and a place to buy an option naked. But given everything we just discussed, right, I'm not even so much looking for Facebook to get destroyed here. Really more so what I'm looking for is for this thing to just take a breather, slow the hell down, consolidate, and let the moving average kind of catch back up, right? Let the price return to the mean. That's what I'm looking for here, guys. And if I did this with naked puts, that back and forth chop wouldn't do me any favor. You buy puts, you need it to dump. I short calls, I'm going to make $1,000 and change as long as we close anywhere under 247.5, right? Hell, we can close at 247, I would be in good shape. So this is easy, guys. It's easy, from an execution standpoint, but for me, in my experience, trading full time for the last 6-7 years at this point, it's a lot less emotional, right? The reason being, guys, is that you don't need to be right. You just need to not be ridiculously wrong. A good example is my short in UNP, right? I'm short UNP here, guys, with a call credit spread, and think about it. I'm short a stock that gapped up 3% today, and I've got no problems with it. Why do I got no problems? First and foremost, proper position sizing. If a trade of mine goes to zero, it is what it is, right? We're on to the next one. Not going to kill the account. But for this trade specifically, I shorted the 175 calls, right? I got $5 of cushion left. This thing's $5 away from crossing the level that would give me any trouble, and it's well above that 21, right? You get these big whopping moves, guys. You're going to get the reversion to the mean sometime soon, 9 times out of 10. So that's why I like Facebook. That's why I like this short, guys. We can wake up tomorrow, Facebook can be up 1%, and my chances of still making money have not been diminished. If I bought puts and we go green tomorrow, you're off to a crappy start. Makes sense? So high probability, low stress trades. For me, guys, that's the best way to create the consistent income that I'm guessing all of you are after. And in my opinion, it's the best way to quickly grow your account. So if you guys enjoyed this video, please subscribe. It means a lot to us. And if you haven't already, you can check us out at focustrades.com. If you're interested, guys, in learning more about some of the swing trading strategies that I use as a full-time options trader, you can check out our summer swing trading course kicking off a few weeks from now. So head to focustrades.com, guys. You can check out what's going to be provided in this class. I hope to see some of you guys there. And until the next video, I'm out of here.